Okay, good morning or good afternoon. Welcome to the FX Street webinar. I'm Ian Coleman. I'm one of the partners directors at Pia First. We supply banks, hedge funds, individual traders, and some brokers with trade recommendations and technical analysis reports, basically. Our system, if you like, is based around technical analysis. So we're looking at correlation, chart formations, candlestick patterns, etc., etc., etc. We're also combining that with our own grey box system. This basically highlights different support and resistance levels that that we use to try and decipher where these currency pairs and other products are moving to. We analyse 30 different products just on an intraday time frame. We do some longer term analytical reports, but they're mainly on Saxo trading floor. Let's just check to see if the picture's coming out. Okay, I've just switched on to the other screen. So today we're going to be looking at the dollar index. We're going to be looking at the FX majors. We're basically going to break them down through time frames to try and decipher where these currency pairs are basically going to go over the next 2 weeks. Okay, I predominantly look to forecast foreign exchange. Steve, my business partner, concentrates on indices, commodities, fixed income, and he'll be doing the webinar next week. So what we're trying to do is sort of cover a 2 week time frame to highlight, I wouldn't call them long-term forecasts, but sort of medium-term forecasts over the next 2 weeks. And we'll talk about our relevant support and resistance levels and what you really should be looking at, and what more importantly, really, I suppose, is where price action is dictating or highlighting that these currency pairs should go to. So what I like to do virtually every Monday or over the weekend is just to look at the economic calendar for the week. Okay, it just gives you a good insight into what releases are coming out, what we should be wary of. I'm not just saying this because this is an FX Street webinar, but my favorite calendar to use is the FX Street economic calendar, because it's easy to use. Okay, you've also got the tick boxes down the left hand side when the economic releases have come out. More importantly, I think as well is this indicator in the middle that basically highlights the volatility of the economic release. Just because we've got all of these economic releases doesn't mean that nothing can happen outside these forecasted data points. We can get what we call news bombs. So even though we know when these specified or specific data releases are due out, we can still get news bombs. We can get some atrocities. We can get, I hate to say it, but bombs going off in different countries. We obviously, we've had the World Trade, we've had the Paris attacks, etc., etc. All these things affect the market. So we can get what we call news bombs. I don't know if that's really a very good name for them at the moment, but we do. Outside of those, we like to see what is going on or what's scheduled to be going on, so that we know what we should be looking for, or whether or not we're going to consolidate. Okay, whether or not it's likely that we're going to get days where we're just going to consolidate. So if you look today on Monday, we've had some small PMI figures out of the Eurozone, and relatively zero releases this afternoon from the States. Okay, ones and twos is basically what we've got up here. We're not really getting into any sort of decent economic releases until Tuesday. We've got RBA's Governor Glenn Stevens speaking overnight. I won't be about for that at midnight. And then Eurozone GDP at 7 o'clock, and then nothing really until Wednesday afternoon, which is the durable goods figures. Obviously going to be closely watched. Everybody's watching the dollar at the moment. And then again Thursday, Friday, really nothing. So it could be a pretty boring week, and we could see quite a large period of consolidation. So we've got to be aware of that. So then we start breaking down the time frames. So what we look to do is we look to go out from a monthly, sometimes to a weekly, then a daily, 4 hourly, and then intraday, to try and get our support and resistance levels and our decent risk reward trades. We don't always trade with the trend. If we regard the counter trend trade to have ample risk reward, then we're more than happy to take it. But we are predominantly trend followers. Okay. Here we've got the monthly chart. We used to explain time frames. Somebody a long time ago turned around and said, you know, how do you use the time frames? What's more important? And the big picture is important. When you get down into sort of, you know, your 5 minute, your 10 minute, and your 15 minute charts, or even, you know, 3 and 1 minute charts, they can be great for entry levels. But you really want to be looking at the longer term time frames just to decipher where the trends are going to go. Okay, so you're aware of whether or not you're counter trending or trading with the trend. So here we've got the dollar index. We've had really most of 2015 was a period of consolidation, and all this did was form a very large corrective channel formation on the daily chart. We've now broken to the upside. So our long-term bias, we've got to remember, we're just hanging around this 100 level at the moment. So again, it's quite a psychological level. We talk about big figures a lot in trading, so we've got that 100 big figure in the dollar, and it will be traded around. And that's another reason why we're probably going to consolidate for a few days this week. But over the medium to long term, we're looking for this fib confluence area. Okay, we've got 102.08, 102.10. That's a 61.8% pullback of this very large decline from 2001 to 2008. Okay, and it's also a 61.8% extension of this 2008-2009 move. So we've consolidated, we've broken out this channel formation that we said to the upside. Okay, and now we're pushing on this 10000 big figure. Now, there's a few things that make us wary this week. Firstly, we've already mentioned that there's nothing really in the way of great economic releases until later in the week. I'm also just going to, I don't know if it'll highlight, I'll show it on the 4 hour chart actually. And then the 4 hour chart, we look like we're just holding into the top of this channel formation. Okay, now we could say it's a channel formation. Far too early to call it any sort of head and shoulders. Obviously the head and shoulders would have to break this level here, which is 99 the figure, and then push lower. But we do want to be wary of this pattern because it's around the 161.8% extension. Okay, we're holding on to this series of higher highs. Okay, we're making higher lows. So we don't want to be buying into the top of this. And also what we wrote about this morning in one of our reports, we're just breaking it down into the 30-minute chart. Okay, we've got this 261.8% extension level, which just happened to be at 100, the big figure. Okay, so and we've pulled back. So what we're looking for this week is really a bit more consolidation and a bit more of a move back before we look to trigger dollar longs again. Okay, intraday, just to let you know, we had support this morning at 99.75. I think what happens a lot of the time is people note down our support and resistance levels, obviously for future reference. So we've got 99.75 as an intraday support. Below there, and what should be solid, is 99.60. Now that's one of our bespoke levels, but it's also a previous swing high. So 99.60 looks solid for the first 2 days of the week. And basically what we'd look to do is we'd look to buy dips around this 99.60 area. It's only if the correction lower in the dollar index becomes more aggressive, which I don't think it's going to, that bias will turn. Okay, so at the moment, the bias is still for buying dips, but not obviously at this level, a deeper correction, which is going to be around about 99.60. Any questions about the dollar? Just noticing that the chart's disappeared there. And again, got any issues with that? All my settings seem fine. Okay, well, we'll keep going. So that's the dollar index, and obviously the dollar index, when we look at FX majors, obviously it's a part of euro dollar, sterling dollar, dollar Swiss, dollar yen, Aussie dollar, dollar CAD. So we can't ignore the dollar. It is the driving force of most major currency pairs. So basically what we're going to do is the same thing. We're then going to flip the bias over. I'm just going to get my other charts on my bottom screen. Okay, and again, we're starting to sound like sort of broken records, but our long-term bias remains bearish. I mean, that's probably something that we've put into our euro-dollar report for about 12 months now, and we still remain bearish. Last month, we actually had an inside month and an outside bearish month. So if we just zoom in on this chart here, okay, we can note that this was an inside month in September, and then October we had an outside month, but it was still inside this previous bullish bar, which was August 2015. We've broken to the downside again in our sort of reports that we've been writing for some time. The euro-dollar pair was in an expanding wedge formation. Let's just show that on this chart, on this daily chart. So for some time we were saying expect trading basically to remain mixed and volatile while it stays within this pattern. And it was this pattern basically. And we've since broken to the downside. We had a mild retest of the breakout level, and now we've pushed lower. So over the long term, our bias is for lower levels. Now this, we believe, is going to be the last leg of the move lower. And normally, if you believe in Elliott wave, or even if you're looking at symmetrical patterns, etc., 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 the last legs are normally the choppiest. Okay, so we get mixed volatile price action in this last leg. So even though we're sort of aiming for, well, strong support, where do you see the next strong support for euro dollar and why? I don't see any strong support until around about 10100. So getting towards parity. And as we break down through these time frames, we're going to explain why. So the bias here is still to the downside. We've broken out that wedge formation to the downside. If we look to euro dollar daily, okay, this was the 161.8% extension level at 10702. We then had sort of a 2-day, 3-day bounce, but all that happened was we had quite a decent short entry level at 108.08. Now that was the Marabuzo level, which is the midpoint from the 6th of November, which was that strong sell-off day, and it was also the low from from the 20th of July. Okay, and obviously this was support, then becomes resistance. So it was a good short entry level. We're now pushing lower, and if we look to a shorter time frame chart, let's just get this up a bit and expand it. And we're getting back into Elliott wave now. Is the pause overnight or the pause, if you like, and correction overnight is just seen as a 161.8% extension. So we're not really looking for any major corrective move to the upside until we get down to 10500 basically, or round about 10500, with that move up being a fourth wave correction. So basically what we're looking at here is 1, 2, 3, 4, and then down in 5. Expect trading again this week to be mixed and volatile. We've explained already that the fact that there's not that much in the way of economic releases, and that should keep intraday trading quite volatile. We're going to see the main call would be the same as the dollar, to sell into rallies. Intraday we've got 106.40. Our prime area, well, 106.46 I should say, is our intraday resistance. But our prime area to get short today is 106.65. I think we're probably going to be lucky if we get to that level. So the medium-term bias is to the downside. The daily bias is still to the downside, and the intraday bias is still to the downside. We can see no technical reasons why you would look for a change in bias or even a larger correction really in euro dollar. There's one thing it's quite interesting. I'm just going to digress a little bit here because I haven't got the charts up. I'll get the charts up before we finish. If I had to do a trade for the week, it would have to be sterling yen, and to sell mild rallies in sterling yen around about 107 the figure. And in fact we'll break down sterling yen next, because I think it's quite a decent risk reward trade, and we're also trying to catch in the move pretty much at the top of the trend. If you look to sterling yen, that is. If we look to euro yen's not that as aggressive a sell-off as sterling yen. Euro yen actually looks like it's in a channel formation that, even though we could probably see a 200-300 point move to the downside before it corrects higher, it isn't as strong as a sterling yen. And also, when we look to correlation quite a bit, euro sterling looks like it's oversold. It looks like the scope for a corrective rally to the upside. So if we were to pick any of the dollar majors that we really want to be short of this week, or long of dollars I should say, long of dollars short of currency, would be sterling dollar. I favour the downside in sterling dollar more than I do in euro dollar this week or probably the next 2 weeks. And just keep that in mind. I'm just going to drop this one of these charts off euro stocks. So I'm just going to delete that view. Steve will kill me later. And then I'm just going to copy this view. Okay, and we're going to change these into sterling yen. We'll explain why. Fancy the downside in this cross. I think dollar yen is overdone anyway. We've completed an ABCD correction on Thursday last week, I believe, at the high. It also looks like a large head and shoulders formation, dollar yen. Medium-term bias for me is still strongly bearish. I also think we'll get a correction lower soon or at least a decent correction lower in stock indices, which will then push us further to the downside. So again, we're just going to break down sterling yen. I've got two favourite chart formations. People who have been here before will know it's they're outside bars and inside bars. The outside bar is different than an engulfing candle in the fact that it takes over all of the previous candle's body. Okay, not just the open and the close. So an outside bar is the strongest bar because it basically shows a complete change in sentiment. So obviously, if you've got a bearish outside bar, you've got the move to the upside. It makes a new high, but then it makes a completely new low, and that is a complete reversal in sentiment. And they're one of the strongest candles you can have. Probably one of the weakest candles you can have is an insider army, where the whole of the price action is inside that bearish outside bar. Okay, sorry, the whole of the price action is inside the previous bar, and that basically highlights indecision. So we've got two things there. We've got a reversal of sentiment and indecision, and that's basically what the market moves from. It moves from trend to indecision, and that's what we're trying to catch, if you like. So sterling yen. The reason I've mentioned that so much. Okay, we've got the monthly chart, strong sell-off, okay, and a decent correction. It's corrected or stalled and reversed around about or in between the 50 and 61.8% pullback levels, and we're talking about, you know, the 2007, 2011 move, and then 11 to 15. So the sort of 4-year cycles that have developed in sterling yen, and then here in August of this year, in August of this year, we've had that strong reversal candle, and these are called acute monthly reversal candles, so AMRs, acute monthly reversals. So we've had a bearish outside bar after a doji month. We had some continued selling, and then we've had a correction to the upside. And again, if you look here, for the month of October, we had an inside bar. So this bar is a change of trend. This bar here is indecision. Okay, if we break it down into a weekly chart, I'm just going to get my other charts up because I know what I've written on these. Okay, so again, we're looking for impulsive and corrective moves. Corrective moves normally see spikes in both directions. I might see small ranging candles followed by large spikes in both directions, etc., etc., etc. We also like to look at previous areas of support and resistance. So impulse moved lower, okay, then this corrective and choppy price action higher. And if we go to a daily chart, you can see the impulse move a lot better. Okay, so this was the impulse move lower, okay, then this corrective sequence higher. And if we just put, I think that's a false candle actually. Let's just have a look at the data on there. 7th of September low, 179.13, 7th of September. Just trying to get it up on my other charts. 7th of September low, 180.34. So that's false data on that candle there, which would make my analysis go out the window basically. Well, not out the window, but wouldn't be as accurate. Okay, so basically what we've looked at here, with this being the low, just in case you wondered what I was doing, is the completion of an ABCD formation or a channel. Come here. Okay, so we're basically looking for this corrective channel to now have completed. And if we break down, so if we are correct on the long-term outlook, okay, and the bias is now to the downside, then this is either a flag or it's the second wave in a bigger corrective wave lower. But either way, and again, if we're correct, and this is what we're looking for, is high risk reward trades, either way we'd be looking for a move down towards sort of 172 the figure. Now if we break it down through time frames again, you can see today we're just probably going to post an inside bar, as with most currency pairs we expect. If we go down, and again, this is false data, it's just not very good. We actually use FX, a chart package called Aspen Graphics and FXCM data feeds for our main charts. It's quite annoying actually. I'm just looking, these aren't right either. All of this data here is wrong, and what I'm basically looking for is for a 261.8% extension today that I've got at 185.55, so even below this level here, and I don't have this spike. Okay, what I do have is a very mild correction higher from last night's open, and this basically being 1, 2, impulse move down in 3, a move across in 4, and then an outside bar and a move lower in 5. So what we're trying to say, or what I'm trying to forecast here, is a longer term move, and trying to get in on the short term time frame to then reap a long term reward. So again, sort of selling this morning around about 186.80 to target 185.85, and then to sell into rallies. But I don't think the corrective rally in sterling yen will be very big. Even these are completely skew with, because that is a definite wrong ticker down there. And what I was looking for, again off my charts, which was a little bit annoying, is the move back up like that. So basically a move down towards 185.55, where we'd look to forecast the right shoulder from them a bit low there, and then we'd look for a bounce, because that would be 1, 2, 3, 4, 5, a bounce in a choppy wave pattern higher towards about 186.50, 186.70, and then to get short later on this week for the next impulse move lower. And of course then, you know, we're looking at sort of a breakout of neckline. Come here to take us down to at least sort of 182 the figure. The bottom of this daily channel formation is actually seen at 181, and that will be our medium term target. We do have some support coming in at 183.03, which will be the first level that we take the medium term short off. So in other words, selling intraday down towards 185.60, then looking for a bounce over 2 to 3 days to get short around about 186.50, and then to leave it, okay, to then try and get a medium term bleeder down to sort of 183 and then 180.105 as this bias turns again in sterling dollar. Let's have a quick look at cable. We'll explain why our sort of correlation looks pretty bearish for this pair. So we've got medium term outlook, obviously impulsive move to the downside, then corrective, very choppy wave patterns to the upside. Outside bar stuck in the middle here, but it was actually an inside outside bar. if you see what I mean. It's an inside soldier or an insider army, but it's actually engulfing the previous candle, so it's not as strong. But we've moved to the downside. We haven't really got any support on this monthly chart until we get down towards sort of 146, 147 the figure. I'm just going to change my other charts over again. So the monthly chart highlights a bearish channel formation with ample scope to move to the downside. The daily chart highlights the channel in the opposite direction. However, I've put this fib on here to highlight a 161.8% extension level. We've got to be aware of it, but there's no way that this is the third wave pattern. Okay, this is far too mixed, volatile for anybody to be able to call it a third wave, Elliott wave. What I think we have got here, which looks better to me, again, still using that dollar bullish bias, but after a correction. Okay, is this 78.6% pullback level? I think that's going to be the main focus over the next few months, you know, trading into towards the end of the year. So 148.55 being the main target. Last week, I think it was Thursday last week, our bespoke resistance was at 153.15. And we sold, I think we sold a rally at 153.26 on Thursday. It was quite a decent level. 153.34 was the high trade. Signals, intraday signals are looking slightly oversold, but there is nothing to highlight. Again, going to 4 hours. There's nothing to highlight that this this sell-off is coming to an end. And even if we put fibs onto sterling dollar, you can see we've pushed past the 261.8% extension level. In fact, we didn't even pause at 161.8. So the bias remains to the downside. We're trying to sell into intraday rallies. We've got 151.65 and 151.85 as resistance levels. The 4 hour chart is about to post a correction count with regards to DMARC. So there is scope for a mild move to the upside, but really we should be looking at getting short in cable if we do see those corrective moves. And we can use correlation again. We can look to euro sterling. I think we just hit our target in that 70.26. I think was 70.25. Nice. Missed it by a pip. Euro sterling. Okay, again, the medium-term focus is to the downside, or the long-term focus is to the downside. We've got outside bars, but we've got to keep, or got to be aware of what the intraday bias and what the shorter-term time frames are telling us. So here we've got a Fibonacci confluence area, okay, around about sort of 65, 60, which I think will be the medium-term focus. If we look over here, however, you can see that April 2006, this was the high trade, basically where we're popping on at the moment. And then this area was quite a decent area of support, resistance. And in turn, it's become quite a decent area of support for euro sterling. Now, if we break it down into the daily chart, okay, then a head and shoulders formation, I don't think so. I think it's a correction. There's ample scope for a correction before the next sell-off. We've put this on there because we have to be aware of where potential support is. But the weekly chart actually closed below this potential right shoulder. Okay, so even though we're expecting a move to the upside, we're looking for that upside move to be corrective. But again, when we say corrective, it could be a corrective rally for a week, 2 weeks. So it could be quite a decent move to the upside. And if we just put our fibs on the shorter time frame, we can see that 261.8% extension level at 69.75 is holding back the bears, and we really need to break above this. Again, what was resistance, what was support now becomes resistance, and that's why we had our target at 26 this morning. Before we can get into this corrective move to the upside, and that's all we think it's going to be. If we just break that off and put the fib retracement tool on, okay, some decent levels to note, just to talk about where our support and resistance are. So we've got daily resistance coming in about 70.69. So even below this 23.6% pullback level. But the main resistance level that we see probably this week and next week is 71.80, and that's just above this 38.2% pullback level. So we're not expecting this corrective rally to sort of overextend above here. And if we just put a horizontal line across, if you note here, okay, this has been an area, probably have to drag it a bit lower there, 71.58, 71.60. So this area has been a decent resistance level and sort of decent support, and now we're expecting it to be decent resistance. And you've got quite a few good barriers here, because we've got the 38.2, as we said, at 71.72. We've got 71.80 as our bespoke level, and then 72, the figure, is this previous swing low. So again, was support, would then become resistance. So really this week, even though we're intraday bullish, this week would sort of look to sell into this zone if, it's a big if at the moment, if it gets there. I mean, all we're doing is really just ranging for the last sort of 4 or 5 days, but the mild bias to the upside, and obviously again using that correlation, using the 261.8% extension, there's ample, and the fact that we're very oversold, there's ample scope for a move to the upside in euro sterling before sellers return. And that's why we're saying we're more, using correlation, we're more bearish on cable sterling dollar this week than we are on euro dollar. Has anybody got any questions about euro sterling dollar, sterling yen, currencies that we've covered so far? Let's just move the chat down and make sure I can see it properly. Dollar Swiss, I won't spend too much time on it. It's -1 correlated. Well, it's not -1 correlated. When euro Swiss was held, then it was -1 correlated. So obviously, if you analyze euro dollar, then you basically flipped it on its head, and if you're buying euro dollar, you're selling dollar Swiss. Because exactly the opposite would happen. Now it's not quite the case. Obviously, Swiss National Bank isn't holding euro Swiss at the 120 level. It's now free floating, and again, euro Swiss is just extremely volatile again at the moment. Medium-term bias is to the upside towards this channel top, which is sort of sat around 106.70. Daily, we've broken out of a channel formation to the upside. Ample scope for a corrective move lower to test that channel breakout, which is seen at 10100, so 10100 basically. Hourly chart's looking a little bit overcooked. I don't tell me you missed that as well. 26 was, I think, was our target. Let me just check. It might be one of those days where we're just missing by pips. Oh no, 102.35 is actually our target. So got a bit further to go to the upside before we hit our. We bought dollar Swiss this morning at 101.85. Just say 102.35 the target, but we're not going to spend much time on dollar Swiss because, as I said, it's virtually -1 correlated. The bias is still to buy on dips while the dollar's doing what it's doing. Dollar yen, big picture. I see this as a potential big move in dollar yen. Price action's been capped around here. There's no fib levels to note, but we've got this bearish outside month. We've then had 3 months of inside price action after that decent sell-off. If we break it down into weeklies, it's not going to tell us too much more. Okay. I mean, originally I thought what was going to happen here was we were going to form a head and shoulders pattern. So this was going to be the strong move up, this was going to be the left shoulder, and this was going to be the head, and then move down to the neckline and then bounce up to the right shoulder and then down again. But as you can see, if we put a trend channel on there, we've pushed past it. So we have to reanalyze, if you like, or we're always constantly reanalyzing or taking note of price action. Basically, what we had here was an ABCD completion. So this is the strong move to the downside. This is AB. Then we have this channel. This is CD. 123.66 was the completed top. We've since today or overnight, we've just bounced off this reverse channel support. So again, it was resistance. It then became support. But I think this move to the upside is still corrective, and this is basically the reason why. Get down to 30-minute chart. Again, this move lower was impulsive. This move has been corrective. If we put fibs on here, okay, 261.8% extension. We did get a sort of decent reaction. This is where Elliott waves always a bit wishy-washy, a bit, how can I explain it better? It's in the eye of the beholder, if you like. You know, people curve fit fib levels, extension levels to suit what their analysis or where their bias is a lot of the time. What you really want to be doing is looking for impulse moves. So how strongly we're going to move to the downside, and then, you know, is the move to the upside as aggressive? We're not actually in this currency pair at the moment. We're looking to get into it, but we're looking at selling rallies slightly higher. But it does make me believe, and again using correlation, that this has got limited upside. We're actually looking at selling. Let's try to get one of our reports up. Looking at selling at 123.35. So basically, what was the swing low? And if we put a fib retracement level on here, so we're looking for areas, confluence areas as well. So here was the previous swing low, and it's also a 61.8% pullback level of this whole move. So we're trying to sell into rallies this morning. close to 123.35. But the reason why I'm mentioning and concentrating on dollar yen quite a lot is because I do believe that this is the start of a medium-term change of trend. So we've got sterling yen that's looking lower. We've got dollar yen that's looking lower, but with scope for a mild correction higher first. The only one that sort of doesn't agree with that yen outlook is euro yen. Even though it's still got a bias to move to the downside this week, as we mentioned, it could be capped sort of, or it could be stopped about 200 points from current levels. It's not as strong as sterling yen, and again flipping that back, that's why we prefer to be short of sterling dollar as opposed to euro dollar this week. So again, our bias for dollar yen is to sell into rallies. Aussie dollar, now the weekly or the monthly chart, that should be a monthly chart really. The bias is still bearish. If we look to the monthly, there is nothing to suggest on the monthly chart that the bias should be flipped to the upside. We've got a 261.8% extension level at 66.60. We broke the trend of higher lows, and all we've done is just tried to test and close back above that level and failed for the last 2 months. If we look to the daily chart, we're in an expanding wedge formation that has an eventual bias to break to the downside. And notice I'm saying eventual bias to break to the downside. Expanding wedge formations are by far the hardest of all the chart formations to trade, because unlike other formations where the range gets smaller and smaller and smaller, like an ascending or descending triangle formation or an ascending or descending wedge formation, with an expanding wedge formation, the trading range can get bigger and bigger and bigger, and it can still stay inside this pattern. We've tried to buy this morning at 71.42, thinking that the overnight sell-off, even though it was quite aggressive, was corrective. We haven't been triggered along, unfortunately. So again, our bias in Aussie dollar is to sell into rallies, but there is scope for a bigger rally before we look for bears to reappear. So we're only looking round about the previous high, obviously using our fib tools again. 73.88 is a 261.8% extension level. Okay, obviously holding within this this chart formation, and then for that eventual bias to break lower. And again, the expanding wedge formation, the trouble with the expanding wedge formation is that the main target is the start of the wedge. So if you look at the start of the wedge, it's only at 69 the figure. To break lower, you're going to break maybe at 70.40. So you're going to get about 140 points topside in Aussie dollar. Where do you place your stop? You see, in an expanding, in a normal wedge formation, which is like hit this, and it breaks, you know, we've wound up to the top of the wedge and then it breaks, we get a decent risk reward level because our stop is just here, just back inside. Whereas on a expanding wedge formation, it's much harder to dictate where your stop's going to be. So again, selling into rallies in Aussie dollar, but with scope for a larger corrective rally before the bears reappear. Dollar CAD, and this will have to be our last one. Monthly. I think we're getting away from the dollar to a certain extent. I mean, obviously commodities have been smashed a bit last week with a stronger dollar. but I don't think that's going to be a prolonged trend. We've stopped at the 61.8% pullback level of 134.66. That's from that 2002-2007 move. There are no reversal patterns on the monthly chart, so we've got none of those AMRs that we talked about before. Weekly, we had our bearish engulfing candle formation, and then it moved to the downside. What I think we've got here is basically an ending wedge. Okay, so if we look to sort of oscillators or indicators, okay, they're going to start diverging. Intraday rallies are going to start getting sold into. We're really going to wait. There's scope for a move to the upside, but I think with that dollar index not as strong today, there's also ample scope for a move to the downside. There's no Canadian figures out this week. There's no oil related news that's expected. I think the medium to long term bias is to the downside, and it's to target this 112 level. Oh, sorry, 120 level, I should say. But we haven't got anything at the moment that would suggest that we're seeing a top out. Using the extension tool. Again, this is the wedge target, 120 the figure, and it's just, we've got the 261.8% extension level just underneath that. I'm just going to flip on the 2-hour chart. Just intrigued by this move. So we've had that move, the last move to the upside. It stopped at the 261, just below the 261.8% extension level of 134.37, and now we've formed an evening star formation, and that's a pretty bearish signal. I think what we're going to do intraday now is move down towards 132.50, and then possibly get a bounce up, form a head and shoulders formation, and then get a deeper correction lower. But the intraday bias is definitely flipped to the downside now for dollar CAD. Okay, so that's all our dollar majors. We've covered sterling yen. We've looked at euro sterling for correlation. We haven't looked at euro yen, but we've talked about it a fair bit. Has anybody got any questions with regards to what we've talked about today? No. Okay, well, good luck with your trading. If you do go to our website, it's www.pia/first.co.uk. You can sign up for our daily free call. I think this week it's sterling dollar, strangely enough. And you'll receive a trade recommendation every day into your inbox. Okay, guys, good luck. Thanks for watching. And I will personally speak to you again in 2 weeks. Steve will be here next Monday. Thanks very much. Bye now.